So Howard, it is such a pleasure having you with us today. I wanted to focus today a little bit more on the financial services sector and primarily on the European continent. When we look at the European market, we actually see that most financial services institutions report return on equity ratios that are or seem to be clearly below the cost of equity. If the current policy doesn't change, what do you think is going to happen? What is going to follow?
Well, I think we're going to see a difficulty in that banks will not be able to provide credit for growth. And what you've seen over the last decade, I suppose, since the financial crisis, is that banks have been required to increase their capital base, which was a good thing because clearly they had too little capital in the crisis. But essentially, you can do that in two ways. One, you can raise new capital. That's been extremely expensive to do. Or secondly, you can reduce your lending. And in many cases, banks have reduced their lending. That, of course, improves your capital ratio, but it means that your balance sheet does not expand. And more recently, we've had the problem of zero, or in some cases, negative interest rates, where one of my bank chair colleagues said to me the other day, he said, we're now the only industry where the cost of our raw material is higher than the price of the finished output. Because you get a deposit from a retail customer, which you can't charge less than zero for, and at the margin, you deposit it at the central bank, for which you get nothing. You get negative interest rates. So it is a very, very difficult situation. The way out of it is not so clear. First of all, I think the banks have to put their own house in order by reducing costs, because I think costs are still too high in the banking system. But they also, I think, have to improve their digital delivery, because without doing that, they won't compete effectively. But I do think that the monetary authorities have to ask themselves whether a position of negative interest rates is sustainable in the long run, and I don't think it is.
So you spoke a little bit about essentially the issue of the input and the output. When I think about this from a business point of view, you obviously have as well the operations in the middle. So we could argue as well, we can drive efficiency, we can drive potentially economies of scale. What do you think this current situation might mean for pan-European mergers or pan-European financial institutions to come on the radar?
Yeah. Well, we have to be really honest about this to start with. One is that at the moment, we are not seeing cross-border integration of banks. We're seeing the opposite. Typically, still, banks that had owned other banks in other countries are typically selling them. So you've seen the French banks retreat from Greece or from Bulgaria recently. And at the moment, it is not just not going forward, it's actually still going backwards. So we have to ask ourselves why that is. Well, I think it's partly because the banking union is not yet a robust banking union. There's a very good paper by Bruegel, a think tank in Brussels, that said we've got currently a timber-framed banking union and we need a steel-framed banking union, by which they mean it has to have a proper pan-European deposit insurance scheme, and the resolution mechanism has to be properly funded, and all that. So we're still on the way there. Now, recently, just in the last week or two, there's been some opening up in Germany of discussions about whether perhaps the Germans, under some circumstances, might support a deposit insurance scheme. But I think we have to be honest that unless we get that, we are not going to see the construction of large pan-European banks.
So you already spoke a little bit about, let's say, the regulatory frame here. And when we think about the European Capital Markets Union project, do you think that is a good idea then for Europe, or is it a bad one?
I think it's a good idea, because if you have a financial system which is very heavily reliant on banks, which Europe's still is, then that is a vulnerability, as we saw in the crisis. And you saw that the Eurozone crisis lasted longer than the American one, because we were so reliant on bank credit, and the banks had to spend a lot of time restoring their balance sheets so that they could lend again. And that process meant that the Eurozone period of stagnation was longer than the American one, where the American banks were a much smaller percentage of funds for companies. So as a rebalancing exercise, even if it means the banks lose market share, if you like, nonetheless, I think most bankers actually would say that's a good thing. Because also if the securitization market revives, banks themselves can do what they do best, which is credit appraisal, make loans, and then securitize them, sell them off into the market, and then do their credit appraisal again. I mean, they actually can add value more frequently if they can securitize and sell their loans. So I think the Capital Markets Union is a very good idea. The only thing is it isn't working.
Let me actually switch focus a little bit and change gears. Obviously, you spoke a little bit about the difficult situation. One threat clearly comes as well, I would say, from fintechs. Where do you think, or who's going to challenge the financial services industry in the fintech market? Do you think it's going to be the established tech companies like the Amazons, the Apples of the world? Or is it actually going to be startups that we don't even have on the radar yet?
Yeah. Well, when I joined the Royal Bank of Scotland 4.5 years ago, when I was asked about which competitors I was worried about, obviously Lloyds, Barclays, HSBC, they're always there. But at the time, I used to say challenger banks. There were small banks being set up, but looking a little bit Me Too, like Metro Bank or Virgin Money, etc. And they seem to be worrying. And peer-to-peer lenders, Funding Circle, Lending Club in the US, etc. Now, frankly, I'm not worried about the challenger banks or about the peer-to-peer lenders. The peer-to-peer lenders haven't yet gone through a credit downturn, and that's going to be a challenge for them. And the challenger banks find it very, very difficult to achieve sufficient scale to be, they're not bad institutions, but they're not worrying me. They don't keep me awake at night. However, if you ask me now, of course, I would quote companies which I'd never heard of 4 years ago, like Monzo or Revolut or N26 would be ones that are very much on our radar. And what will the big techs do? Now, among the fintechs, the problem that they've got is that they can acquire customers, but so far they haven't found a way of making money out of them. And, if they ever found that, they'd be much more worrying than they are. But at the moment, they're good ways of spending a lot of money on acquiring customers, but it's not clear quite how they're going to monetize that. But the big techs, of course, have got the customers anyway. And the question is whether they are going to move into banking. An announcement today by Google that they're thinking of offering bank accounts in partnership with Citibank and ePay or whatever. And they, that could be very concerning if they decide to take the plunge and become regulated as banks. So far, they have not wanted to have all of the regulatory paraphernalia that comes with being a bank. They've been wanting to do everything short of that. And if they do, then they can be good partners for banks. But undoubtedly, they could make a move forward, and that would be quite difficult from a bank's perspective.
Howard, let's hope the best. Hopefully you're not going to have too many sleepless nights. It was such a pleasure having you. Thank you very much for your time.
Thank you.